little bit of a dip buying Friday, 30 minutes till the start of trading. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
It has been a whole week. Stocks, precious metals, and Bitcoin attempt to come back as dip buyers unite.
And also in that week, it's been a busy one of tech earnings, underscoring massive AI spending plans, with a handful of companies set to invest $650 billion just this year.
Yeah, that's the capex from only 4
insane
American companies. Plus, the view from the Atlanta Fed. Raphael Bostic joins us for an exclusive interview with Michael McKee following a string of weak labor data.
I feel like we've been through a battle this week. Maybe we've come out on the other side, a few scars.
One battle after another.
Yes, a great film, a great film. Anyway, I want to show you what Amazon is doing. Maybe the battle isn't over. Down 8.33% this morning, spending a whopping $200 billion on its AI efforts this year. That is 27% higher than the average Wall Street estimate. The money will predominantly go towards the company's AWS cloud unit. You can't just spend and keep spending and get away with it, apparently.
Well, I mean, it's only an 8% drop, right? They're spending $200 billion on capex. Stellantis, by the way, says its pivot away from EVs will cost the company a whopping $26 billion. More than Ford, far more than General Motors. It's the biggest EV write-down that we've seen in history. They'll cover cancellation of certain models, compensation of certain suppliers. You can see the stock is down. Stellantis has lost basically a quarter of its value in one session, Dani.
It is wild. We're going to talk about that and Amazon. And starting with Amazon, the CEO, Andy Jassy, says the lion's share of AI demand is yet to come, and they are investing to aggressively change the scope of the company.
I think this is an extraordinarily unusual opportunity to forever change the size of AWS and Amazon as a whole. We see this as an unusual opportunity, and we are going to invest aggressively here to be the leaders, because like we've been the last number of years, and like I think we will be moving forward.
Joining us now is Bloomberg Tech's Ed Ludlow. Ed, I don't know if this market wants aggressiveness right now.
Yeah, aggressiveness is $200 billion, which was a significant delta beyond what consensus was for capex. And the sell side are calling it sticker shock. It's the same story we've been talking about, which is the market questioning if the payoff is there and if it will be worth it, right? Matt made a very important observation that combined $650 billion capex is just 4 American companies. But the concern with Amazon, and one reason it's down more than 8% in the pre-market, is of those 4, it might enter negative free cash flow, which for Amazon is a pretty severe change of financial circumstances. So the market wanted evidence, right? AWS growth is at 24%, fastest pace of growth in about 3 years. But the operating income forecast, which for the current period at the top end, $21.5 billion, is below consensus. All of those competing financial metrics have spooked the market a little bit. But I would say, look at any corner of the market today, other than Amazon, memory chip makers, the GPU makers, the chip equipment makers, the nuclear stocks, the data center supply chain, they are all higher because they'll benefit from that spending.
And this is a company, Ed, whose stock has underperformed other Mag 7 stocks, and one whose business model doesn't seem to revolve around AI as much as Microsoft's with OpenAI, or Alphabet with Google, or Meta with Facebook. So it's interesting that they're spending more than any other company in the Mag 7 on capex this year, or at least forecasting that.
Yes, but they also the clear number 1 player in cloud computing. Now, cloud computing can mean anything from storage through to running any basic level of software just in the cloud. In the AI context, what Amazon has found more difficult is to communicate to the market specific AI-related revenues. With Microsoft, for example, when you look at the Azure cloud growth, the market basically extrapolates more easily and says, okay, we see that that's directly AI-driven. Amazon has given us different metrics. They give us a revenue run rate of AI-related revenues. That can be involved directly of corporate and enterprise customers using AWS. It can also be the specific AI model and other services that AWS sells. One final thought we just pointed out, loads of your audience will be saying, well, I know Amazon as Amazon.com, which accounts for the vast majority of revenues. But the reason that it really matters, of course, is that it's about profit. And the cloud computing business has accounted for the majority of operating income for quite a long time. When you commit to that level of spending and you gave the forecast on operating income that they did, that raises some concerns about the health of your cash cow.
All right, but important to point out the AWS business as opposed to, you're right, Ed, the Amazon.com shopping business or the Amazon Prime video business that we laymen often think about in relation to this company. Bloomberg Tech's Ed Ludlow has a very busy day. Join him at 11 a.m. with Caroline Hyde to wrap the most important tech news of the day, of the week, of the year. Stellantis, by the way, says its reversal on electric vehicles will cost the company more than $26 billion. Stellantis CEO Antonio Filosa blamed his predecessor, Carlos Tavares, for going all in on EVs and failing to respond to shifts in the marketplace. Bloomberg's Craig Trudell has run our autos coverage from 3 different continents around the world. He joins us now out of London. So, Craig, this is much bigger than Ford and far bigger than General Motors. No one has taken an EV write-down to this extent yet. And you could argue that Stellantis has been the most hurt by this, right? I mean, they continue to see a loss in terms of their Jeep business, which at one time was the crown jewel. They've gotten rid of the Hemi only to bring it back. And I don't think a lot of people are buying the Charger EV.
No, I think that's exactly right, Matt. And I think this is partly a story of they had the furthest to go, right, and especially in North America, where they were really behind in terms of investing in electric vehicles and standing up battery plants to feed into those, plug-in models. To have to sort of reverse course after trying to play catch-up aggressively under the Biden administration just was going to mean that this was going to be quite costly for them. I think also just sort of buried within this announcement, they have a 5.4 billion euro write-down related to warranty issues. And so that's unrelated to EVs. That has to do with the fact that this is also a company that is having quality problems, something that it also shares in common with Ford. So I think kind of across the board, this is a business that is really having some operational issues. And you see a really extreme reaction in the share price as a result of that.
I got a message from a viewer just yesterday, Craig, who said, I can't believe I've seen a $163,000 Jeep. Like, that's just not what Jeep is about, that kind of price tag. And I thought Bloomberg's story today was really well reported and well written because it showed that a lot of dealers, too, were unhappy about having to ask customers for that much money or for, $5,000 for a set of LED lights and some off-road wheels or for a couple $1,000s for a sliding roof. And they're going to be able to lower prices and have been doing that.
Yeah, and I think that is helping. That's very much sort of a part of the plan for Antonio Filosa, who took over, only less than a year ago. I think under Carlos Tavares, you saw real aggression to try and, move Jeep further up market. That worked for a time, especially when you saw sort of across the industry, everybody was able to take price during the pandemic. But I think, the slow move on Stellantis' part to sort of wake up to the idea, like, look, our consumers are only willing to go so far, left them with way too much inventory in late 2024. That cost Tavares his job, and it's really been difficult for this company to sort of find its footing since then.
Craig, always a pleasure to speak with you. Craig Trudell there, again, who has had a long history of covering autos with a nasty plunge for Stellantis. Also, be sure to listen to Hot Pursuit. Did you know that Matt has an autos podcast with Hannah Elliott that is fantastic? You can listen to it wherever you get your podcasts.
And by the way, we aren't EV averse. A lot of people write in and complain that Hannah and I slam EVs too much, but we really both enjoy certain electric vehicles. Yeah, so
I can confirm that I know you enjoy an EV.
Even the Dodge Charger EV was one that I really enjoyed spending a week driving. So definitely check out Hot Pursuit if you care about cars.
It's a must listen to. Elsewhere in the markets this week, Matt, stocks in Bitcoin, they are rebounding. Have we found a floor? Gold also finding some support, but it was a week that saw investors pull back from the most popular trades. Joining us now is JP Barnett, a senior strategist for Bloomberg News. JP, was this just plain and simply a momentum meltdown this week?
Well, to some degree, it definitely was. I would say like the market is moving through like big topics that are going on right now. The one is like the momentum unwind or deleveraging, whatever you want to call it, from gold to silver and Bitcoin. And I mean, like, honestly, gold and silver should never and have never meant to be a momentum trade. And like the way up was crazy and the way down is now equally crazy. And all the leverage that we have seen from, I guess, presumably mostly retail traders is now getting unwind. And the other aspect of the market, which is like also this week sometimes lets me shake my head and go, what's going on here, is like that AI complex where we weirdly work through like what is working and what is not working in terms of like CapEx spending and reward. But at the same time, we are also already like pricing all the disruption into certain areas, from exchanges to European media companies, and most pronounced in software stocks, where I feel like, okay, what the market actually wants here. Are we sure now AI is working and we need to price those disruptions? Or are we still figuring out if all the spending is actually worth it? So the whole market sometimes has a bit of a narrative where I feel like a lot at once. And let's not forget all that under the umbrella of like an economic topic, a US dollar topic, a US rates path topic that is still not having its final chapter written. So a lot to digest right now.
JP, thanks very much. Bloomberg strategist JP Barnard talking to us about the trades that have worked and no longer are, like momentum trades have been falling apart. Let's get a look at some of the individual movers on our radar this morning. Reddit gave an upbeat outlook for ad sales after earnings topped expectations. Roblox daily active users were above estimates, and its sales outlook also beat expectations. And Novo Nordisk said hims and hers is unlawfully mass marketing unapproved, untested semaglutide pills for $49 a month. Novo called the move illegal and said it poses a significant risk to patient safety. But what is a patient to do who wants to lose weight and can't afford to pay Novo prices?
Well, also, the problem for me, too, was like they didn't say what the significant risk was. If I were to read that and I was a patient, I'd be like, you're just upset and you don't want them to sell it. Tell us what the risk is, and then maybe we won't take it. Yeah, it'll be interesting to watch this battle play out. Take a look at futures, Dani. A little bit of a bounce here. Yeah, have we found a floor? A pretty significant bounce for Russell 2000 futures, up 1.4%, up 0.5% for the S&P 500. But still, we did see the S&P fall for 3 straight days, the worst since November. The software component of the S&P 500, that fell for 7 days. It's now 30% from its October peak into a bear market. Coming up, Bloomberg's Michael McKee is sitting down with Atlanta Fed President Raphael Bostic. An exclusive interview from the Peach State. That's right after this break.
Good morning. I'm Michael McKee, the International Economics and Policy Correspondent for Bloomberg, and we are here in Atlanta. Welcome to all of our viewers and listeners around the world on Bloomberg Television and radio. We're speaking with the Atlanta Fed President Raphael Bostic, who is retiring at the end of this month. So this is sort of your HR exit interview.
Mike, it's always good to see you.
I want to ask you, as you travel around your district for the past year, what's the mood like among companies and consumers? We've seen the surveys show that people are getting very, very pessimistic.
Well, I'd say it runs in 2 ways. So first of all, what has been true throughout the last year is a tremendous amount of resilience on the part of both businesses and consumers. You know, when April 2nd, when the tariffs were announced at very high levels, that put everyone back on their heels, and there was a lot of uncertainty. And what's happened through the year is people have figured out ways to deal with that uncertainty. So as for today, I think most businesses and most households are not thinking that the worst of the possible outcomes are going to happen. They're not sure they can get to the best ones, but everyone's trying to find a steady state where they can get through. So I think the sentiment is one of cautious optimism, but I'd put emphasis on the cautious as opposed to the optimism. I think people are really trying to wait and see what happens.
Well, what do you think that means for the economy?
Well, I think it means that the things that we've seen for the second half of 2025, we will continue to see through 2026. And I've talked to a lot of folks over the last 6 weeks or so, and they said, we think our experiences in October, November, December are likely to move on. And then there are some reasons why they think it might actually get stronger. The tariffs, people have gotten used to those. And so those effects will have run through by the middle of the year. We see some of the stimulative aspects of the tax bill last summer. Those will be coming on board. And if consumers start to feel like there's more certainty, then I think businesses think there's some upside potential in the economy.
Well, this last week, we've gotten a lot of bad news on the employment front with ADP and Challenger and the other numbers that have come out. Does any of that, you don't have another meeting to vote at, but does any of that give you pause about the Fed pausing at this point?
For me, no. I think we've been in a situation where inflation has been too high for too long. And by many readings, it's been kind of marking time. It's been at a plateau well above our target for the better part of 2 years. That's not acceptable. And for me, I think we can't lose sight of the inflationary concerns. The labor market is very turbulent right now, and some of it is because there are some big structural things that are happening in the economy. When I talk to businesses, they're reluctant to hire entry-level people at the same ways that they did before, because they think things like AI can replace that and they can deploy resources for other things. And I'm hearing that kind of reticence. There's also the reality that during the pandemic, a lot of companies ramped up because the demand ramped up, and they've been slower to right size. We see a bunch of that right sizing happening as well. And then we have issues around the labor supply and whether the immigration shifts are going to be temporary or permanent. And if they're permanent, then we're going to have a lower steady state job creation. So for all those reasons, I think it's very hard to make a clear statement. And then, of course, we don't have a jobs number today, right? So we're not getting the data in a timely basis. My team tells me it'll be April or May before we start to be able to draw clear signals from the data to really understand what's going on.
Yeah, we wanted to wish you a happy non-jobs day today. You started a long and varied career at the Fed in 1995. Since then, what have you learned about the economy and about inflation?
Well, I think for the economy, one thing that is true is that it is a very complex economy. It's very large. And to understand it, you really have to get out and see all parts of it. And one of the things that's been great in my role here is I've had a chance to do that. I think it's given me a deeper understanding of just how people engage and experience the economy and how they make decisions to move it forward. In terms of inflation, what I've learned is that we really don't want to have inflation. Right? Once inflation gets entrenched in people's minds, it changes how the economy evolves. And it's one of the reasons why I think that we need to keep our policy in a restrictive posture so that we get inflation back to 2%. That's paramount. High prices and the prospect of rising prices really do have a lot of families on the edge. And you all have reported a lot about the K-shaped economy. There are lots of families that are feeling very precarious right now, and that's a source of concern.
Do you think the economy is becoming more K-shaped?
I don't know more. I mean, it's been that way for a while. Just before the pandemic, I had been talking about this, and we were trying to find some metrics to really detail how there's a split. I used to call it the barbell economy, where either you're at the high end or at the low end. The K-shape is the same thing. What I know is that there are a lot of families that are precarious and are feeling very uncertain about their prospects for the future and the prospects for their children, for that matter. And that concern, I think, does underlie a bit of the lower and the low consumer confidence that we continue to see being reported. And what we'll need to do is really give people reasons to be optimistic, show them where the new jobs are coming from, and show them how they get the skills to compete for it. Well,
this week, Treasury Secretary Bessent said the Fed has lost the confidence of the American people. Do you think you have lost the confidence of the American people? In your district, do you hear people raising questions about that?
That's not been my experience. As I go around the 6th District, people tell me, we're grateful for what you're doing. You have a very hard job, and we want you to be as data dependent and as open to information so you can make the best judgment that you can. Look, the world is very complicated. It's actually more complicated today than it has been my whole time here. So what I think most people understand that, and they know that we're doing the best job that we can under very difficult circumstances.
Well, you have a unique perspective because when you took office at the Atlanta Fed in 2017, you were the first black president of a regional Fed bank. Looking back now and hearing the criticism that we get from Washington, do you think the Fed was too woke and perhaps the inclusive employment idea was a mistake?
I don't think so. What we have is an economy that needs to work for everyone. And if we're not mindful about the ways that the economy is not working for people, then our maximum employment outcome is going to be lower than it can be, and it doesn't serve the American people as well as it could. So I think the focus on every American and every American's experience is exactly the thing that the Federal Reserve needs to be doing. That's different than saying that that is unduly influencing our policy decisions. And I will say, through this whole episode, the whole time I've been here, you can look at the market predictors and the market projections. They, in many instances, were more extreme than ours, right? And so I actually think we've been doing the best that we can, and we've been data dependent in the way we've been for 100 and some odd years. So I don't take on board those arguments.
Well, the new chair designate, Kevin Warsh, says the Fed needs regime change. What does that mean to you?
I have no idea. I mean, you're going to have to ask him what that means. Look, I think we definitely need to be data dependent. Our bank has really taken on board the notion that we need to go out and engage and talk to business leaders, find out how they're engaging with the business, how they're making decisions. And that combination we have found to give us the best perspective on how the economy is performing. I don't think that we should change from that. I think we might need to even lean in more to those non-official data sources as the economy is changing so rapidly, because those are all looking backwards, and we need to be looking forward.
Well, he's been very critical of what he calls the Fed's mission creep. Does he have a point?
I actually don't even see the mission creep argument. Like for me, on the banking side, for example, our job is to make sure that every bank that's alive today is alive tomorrow. And so we need to make sure that banks are thinking about the risks that could cause them to need to deploy capital in ways other than in loans. And so having conversations about those things, I think, is fully appropriate, and we should be doing that. We don't tell banks where to lend. I've never told a bank, don't do a loan or don't do that sort of thing, and my examiners don't as well. I think we're asking prudent questions to make sure that financial sector, business leaders are aware of trends that could be introducing risk.
Warsh also says that he wants to shelve QE and significantly shrink the balance sheet and perhaps go back to a scarce reserves regime for managing the interest rates of the country. Could he do that? Would that be a good idea, or how hard would that be?
So I think it's doable. To me, I was not at the Fed when the decision was made to go from the scarce reserves to an abundant reserves regime. I do know there were tensions and a lot of volatility that happened in the scarce reserve environment. And so if you were going to move back to that, I would hope that there'd be a discussion about how to mitigate that volatility, because so much of what we've done is just to make sure there's liquidity in the marketplace, and that liquidity is actually important to make sure that consumers and businesses are not worrying, can just worry about, is this a good decision, as opposed to whether I can execute on the good decision. That leads to a different kind of allocation of capital. Is not helpful.
Tell me about Jay Powell and what he means to the Fed.
Jay has been great. He's a colleague. I consider him a friend, very open and very transparent. And he's led the institution. He's been at the institution for a long time, through a lot of significant periods. I think his legacy will be quite positive. And I'd be sad to see him leave the board if that's what he chooses to do. But it's been a great relationship for me with him, and it's been my pleasure to serve under him.
Do you agree with the sentiments he showed when he made his video a couple of weeks ago?
So I'm not going to talk about the specifics of the legal action from the Justice Department. What I would say is this: it is essential that the Fed perform its duty mindful to its charge, which is stable price and maximum employment, to really focus and create long-term stability and predictability in the U.S. economy. And if you want to call that independence or whatever you want to call it, you can do that. But that's the charge, and we need to stay true to that, even when people with different horizons and different objectives have their views about what we want to do.
There were questions about the Fed and its ethics rules. You ran into some problems, as did others, with those. Was that the rules, or was that the individuals who created the problems?
Well, individuals make the rules. I will say, for me, I thought I was doing the right thing, and I found out that I wasn't. So once I discovered that I wasn't doing that in the reporting side, then I change them, and I change our rules. I want to make sure that no one goes through that at all. And I've been grateful that the IG report validated that I wasn't using insider information. And so to me, I think we need to make sure the rules are clear and they draw bright lines so that lay people can come in and use them in ways that allow them to avoid the challenges that I had. And then, there may be some people that have problems, but that's not what I've seen in terms of my experience.
Well, last question. What would you tell Donald Trump if you had the opportunity about Jay Powell and about the Fed?
I'd say Jay's trying to do the best that he can. He's a smart man. He understands markets. And if you want him to succeed, you should let him succeed.
Well, the Fed itself, do you think it is under threat from this administration?
Threat, I don't know. What I would say is my whole time here, and I think that most of the history of the Fed, there have been people who thought the Fed should do other things and talked about that and called them out. This is another one of those times. And we need to be mindful and we need to be solid and resolute to understand that that comes with the territory, and with that territory then requires our strength and our resoluteness to stay focused on what we've been asked to do.
Raphael Bostic, thank you very much for joining us, President for another couple of weeks of
got a couple weeks
the
left.
Atlanta Fed. I'll send it back to you in New York.
Bloomberg's Michael McKee there, speaking with Atlanta Fed President Raphael Bostic. All right, moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are up across the board with dip buying going on after the drops that we saw yesterday, really across assets. Right now, S&P futures up about 0.5%, as our NASDAQ futures. Small caps gaining 1.4% this morning. Maybe that's on some optimism about the Fed. I recognize it's Jennifer Garner.
Correct.
That's great. Once Upon a Farm, OFRM, I guess, is the ticker there. And also, my mother was her advisor at Denison University.
Oh, I thought maybe we were going to say for this IPO.
No,
that
I mean
maybe
in college.
makes more. Yeah, that makes sense.
Which was
very cool for your mom.
Which was a while back. Okay, Spyglass Pharma ringing the bell at the NASDAQ. The important thing to note today is that we have dip buying going on, even after Amazon said it's going to spend $200 billion this year on CapEx. That's what has been hurting Mag 7 companies throughout reporting season thus far.
I say dip buying, but not for Amazon, to be
Yes.
clear. Those shares are still getting hurt, and I actually have a look at them and what they're doing at the open at the moment. I think, there we go, there's today's trade. So you can see it was already down 4% yesterday. It adds to that, down almost 9% this morning. As Matt, as you said, $200 billion on its AI efforts. That is 27% higher than the average Wall Street estimate. The money will predominantly go towards the company's Amazon Web Services cloud unit, according to Andy Jassy. But even after the sell-off, it is clear this market is nervous if you're putting up hundreds of billions of dollars worth of spending, even if it's on AI.
Yeah, a big drop there, to be sure, especially considering, so many people associate the business with other things than AI. Of course, Amazon Web Services, as Ed Ludlow tells us, is the profit center for them, and it does have a backlog in terms of its cloud services of $244 billion. Stellantis says its pivot away from EVs will cost the company $26 billion. The write-downs cover cancellations of certain models, compensating suppliers, and I would hope also bringing back other models. We need to see the 6.4-liter Hemi V8. And they're going to be lowering prices as well across the board, but especially at Jeep for the base price and for options. So look out for that. Joining us now to talk about all that's going on in the markets right now is BlackRock Global Chief Investment Officer of Global Fixed Income, Rick Rieder. And Rick, we book you on every jobs day, but this is yet another Friday when we don't get the jobs report because of a short government shutdown. It looks like we could have another one, partial shutdown, at the end of next week. What do you make of this sort of muddy data picture when we don't get the things we need in time?
Well, so first of all, it hasn't been jobs day in a number of months anyway, because we're not getting any of those. So I think the last 3 months we've had negative. We had a government shutdown, but you still had negative jobs. Listen, I mean, it's a little trickier when you don't get the actual published reports. The markets pivot off it. By the way, the volatility markets, you strike a lot of options in and around those dates. So it does create a little bit of trickiness. That being said, I mean, particularly for jobs, and we've talked about it a number of months on your show, you look at what we got yesterday. Look at the JOLTS report. You look at the Challenger job cuts. You look at the claims data. You look at the ISM services in terms of jobs. Like, there's no ambiguity around where we are in the jobs market. We're having a really tough time. We're watching productivity explode higher in terms of growth being really good, but a job market that's really tricky.
That dichotomy, Rick, is the most fascinating. Well, there's a lot of interesting stuff going on, but it's one of the most fascinating things about this economy, because it's difficult for anyone to say, even with jobs looking very challenging, that we're heading anywhere near a recession, as long as the Mag 7 is spending, like 2.1% of GDP on CapEx, as long as a government's running a 6% plus deficit. Is this economy going to be okay, even if the jobs market starts to have some cracks in it?
Yeah, the answer is yes, and I think people don't look at jobs and look at this economy like it was 20, 30 years ago. You have an extraordinarily different economy, service-oriented versus goods-oriented, but you've got an economy that's operating incredibly well, but only on a couple or three cylinders. Today, you've got, like you pointed out, you've got CapEx that is robust and will continue. You've got consumption that is robust, but it's driven by wealthier, older savers, and it's part of why the interest rate tool is not nearly as effective as it used to be, because that cohort is doing extremely well. Where the burden today is in terms of low income, small business, younger people. And so, when you aggregate the data, and I hear a lot of people talking about, oh my God, the jobs market is softening, the economy's going to come under pressure. This is an economy that's more asset-oriented than labor-oriented, and that cohort, I don't want to understate this. We have a problem in terms of we need to employ more people, but that cohort isn't that much in terms of aggregate spend. So the economy can continue to motor along, and productivity, I mean, you watch it play out every day. I mean, now the equity market has taken it on about where is productivity manifesting itself effectively, some spaces, not other, who are the winners, who's building a moat, who's not going to be a winner in this. But at the core, you're watching something play out that's pretty historic.
Anthropic putting out another AI tool, this time for financial analysis. They did earlier this week for legal services, both of them kind of rocking the market. That will affect sales at big companies, I imagine, big and small, as well as the jobs picture, right? We're talking to a lot of people. Yesterday, we were talking to Mike Arrighetti from Ares, who pointed out that, the younger talent, the new hires aren't going to be doing the same work and may not be as plentiful as they once were in that industry. What do you make of AI changing the way we work, or the fact that we work at all?
Well, Mike's a very smart guy. I would say a couple of things. I chair the board of, we have 14 charter schools in Newark, New Jersey, and we just had a discussion this week at our board meeting about what is our curriculum going forward. How does AI evolve how we teach kids? What are the disciplines we're teaching our kids for going forward? How do we use AI to augment a traditional teaching process? This is all new territory, and this is all new land in terms of where we're going. Listen, I think there's a bunch of things that are, that have been standard operating procedure that, that we used to teach people for, and quite frankly, AI is going to fulfill that function going forward. I still think learning and interacting with people and the core of education will be sincere to what it was. But gosh, there are so many things we got to think about what can AI do that can make the economy more efficient, make people more efficient, and then move people into the zones that are going to be fulfilling going forward. But that is, I'll tell you, Matt, there is no roadmap for this.
Well, what do you make of, I look at BINC, the ETF that you manage very well, and we'll show in a second how you've beaten returns of the benchmarks by a lot. But there's some corporate assets there, right? 45%. And I wonder how you judge whether or not a company has a moat, what that moat would look like so that it can defend itself against AI disruption.
So Matt, how do I describe this? By the way, I will take it in a couple of different directions. One, that's interesting. Like you hear the discussion about CapEx, and the CapEx was too high. And I would argue there's some other things at play there. CapEx is your moat. CapEx and R&D spend are the way companies can build their moat, and it's actually data utilization. And the companies that are exploiting data effectively, that are building bigger moats, that is at the core of what is happening. There's something also that's different today. Some companies, the free cash flow generation that's been so robust over the last couple of years, you see some of these big companies buying back a huge amount of stock. Now they're spending more on CapEx. It has real ramifications for the technicals in the equity market that we got to think through. Listen, it's a lot of hard work. Yep, go ahead.
Well, I just want to jump in about the other hard work you do at Bink and how you're thinking about positioning the fund and where on the curve. Yield curve just shy of its 2022 highs, somewhat reversed a little bit yesterday, but some of that steepening continues. Yeah. We have an incoming Fed chief who's been talking about trying to shrink the balance sheet over at the Fed. When you think about the rest of this year, are you thinking about changes to Bink at all? Where do you want to be positioned for the road ahead in fixed income?
So a bunch of changes. Your point about credit, we've reduced some credit, we've reduced some IG, because quite frankly, it's not that fulfilling. We're going to get a lot of supply. The spread's not that interesting. We've cut a little bit of the low quality, high yield. By the way, we're running a bit less high yield than we're running overall. We've added to mortgages, although recently, last few days, maybe we've cut a little bit of mortgages because the balance sheet discussion becomes a little less enthusiastic than it was before. But we still like mortgages. We like EM a lot. The dollar will stay contained. And so EM, the yield differential between EM and high yield, is as good as it's ever been. And then the key one for us is securitization markets that allow you to structure the collateral, the covenants, what your attachment point is. So we love the securitization market. But you're right, it's a different expression, a little less credit, a little more EM, a little more in the securitization zone. By the way, Europe killed it last year. And now the benefit you're getting from Europe is not nearly as robust as it was. So we've dulled down a little bit of that and more Asia in the portfolio. So yeah, we've been moving around a fair amount to keep it dynamic and where we think the best opportunity is.
Hey, Rick, we're going to have to leave it there. Thank you so much for joining us. We look forward to you talking next, not Jobs Friday. Hopefully it will be a Jobs Friday next time we talk. Rick Rieder of BlackRock. All right, let's get a check on your equity market right now. About 10 minutes into your trading day. Have we found a floor? We're up 1% after 3 consecutive days of declines for the S&P, 7 days of declines for the software sector. It's down almost 30% from its high, so we're in a bear market for software. Leading us higher is NVIDIA this morning, and Broadcom and Apple and Microsoft. So some of the rebounds of the things that were hard hit. I guess NVIDIA and Broadcom do well when you get $200 billion thrown out there of spending from Amazon. The banks having a good day. JPMorgan, Eli Lilly, Tesla rounding out the top 10 of the movers. To the downside, it's Amazon. Again, it's those earnings, that punchy spend that was hugely above what was expected. Amazon.com falling 8%. Alphabet has another rough day after yesterday. Google also suffered too. It was down 1.2% today. Julian Emanuel writing in his note, the reaction to Google, despite a double beat, just shows the intensity of this market. If we look at what the individual sectors are doing today, let's get a look at that. Consumer discretionary, that's falling 2.6%. A largely positive day, despite the fact Amazon is dragging things down and Meta and Alphabet are down. That's why communications isn't doing well. Tech is up 2.6%. Industrials, financials, utilities, those also rallying 1%. I guess it's the good old question of, was all of that this past week, was that the worst of it, or is today a bounce of a dead cat, Matt?
All right. Dead cat bounce is one of my favorite Londonisms. Coming up, 4 Magnificent 7 companies have forecast capital expenditures that will reach $650 billion this year. Some are getting punished for it. We discuss with Mandeep Singh next. This is Bloomberg Open Interest.
Good morning to the dip buyers. Thank you for lifting this equity market up more than 1% for the S&P 500 and the NASDAQ, also 2,000. Check out this outperformance, up 2%. 8.25% after already outperforming the index for a large part of this year. Let's look at some of the top calls. Some of the analyst action we're focusing in on. First up, Ares. That gets upgraded at Deutsche Bank, which says recent worries about private credit and AI disruption are overdone and don't change the firm's long-term outlook. I should say that's really exactly what Michael Arrighetti, the CEO, told Matt and I yesterday. Deutsche Bank, for their part, views the post-earnings pullback as a buying opportunity, which Mike also talked about yesterday. Those shares are up 6.8%. Next up, Citi, they upgrade Estee Lauder, saying that the post-earnings pullback also creates a buying opportunity. Lots of opportunities out there. The firm says results were pressured by weaker demand in Japan and Korea, but sees improving outlook in its Beauty Reimagined strategy, driving better sales. Finally, D.A. Davidson downgrades Amazon after the tech giant forecasts roughly $200 billion in CapEx, a figure higher than the analysts there and most of them had expected. The results highlight concerns about how much big tech are spending on AI-related investments and when they will pay off. Those shares down more than 8.5%, Matt.
All right, let's stick with Amazon and AI CapEx with Bloomberg Intelligence Global Head of Tech Research, Mandeep Singh. So, Mandeep, today we get an even bigger number from Amazon than we got yesterday from Facebook. From Google. They're going to spend $200 billion on CapEx this year, and the market is punishing them, almost decimating the market cap of the company. Does that make sense to you?
It does. And look, these are eye-popping numbers, as you said. And when you look at Amazon, even though they had an acceleration in AWS growth, 24% was their best growth in the last 3 years. But, the $200 billion justification is still hard to find because Amazon right now is renting, a lot of the GPUs and the accelerators, but they're not using it themselves the same way as a Google is. So that's where, the market is trying to figure out, is the GPU rental business good enough, for the scale of CapEx that Amazon is talking about compared to a Google as well as Microsoft, which has that collaboration with OpenAI that is going to last at least for the next 5 years. Amazon, on the other hand, has to rely on OpenAI or Anthropic, which are also going to rent GPUs from Microsoft and Oracle. So it's not very clear the backlog visibility for Amazon is as good as the rest of the hyperscalers. And when you look at the $200 billion CapEx number, it's probably the largest one amongst the hyperscalers. So I can understand their reaction today for the stock.
Mandeep, could they have said anything that would justify that amount, or is that insurmountable?
Well, I think you want to see a very steep acceleration in AWS growth. In fact, for Google, we are expecting almost 60% growth in their Google Cloud business, in addition to what they are doing on the search side. So from that perspective, you want to clearly lay out what the AI contribution of the workloads is. And in the case of Google, we estimate it's around 20% of the growth from that 48% came from AI. For Amazon, probably it's 200 to 300 basis points, and they should lay out exactly how it will be in 26 if they plan to spend $200 billion in CapEx.
In terms of what they're going to do with this money, Mandeep, I guess they're going to buy land, put data centers there, buy chips, put them in, and serve customers. They have a big backlog, right? $244 billion apparently of cloud backlog. I don't know the significance of that number or that claim, but they're just trying to meet the demand that they have, aren't they?
Yeah, but compare that to backlog of Microsoft, which is over $650 billion, including $300 billion from OpenAI. In fact, Oracle has a higher backlog than Amazon right now because of that OpenAI partnership. So that's where there is not enough clarity. Are they going to use those chips themselves for training their foundational model? If they're going to rent it, who is the big buyer? Because Anthropic is ramping up on Google TPUs. So that's the clarity that's missing in that backlog number. And in terms of their own usage, yes, the e-commerce side will be deploying a lot of these accelerator chips, but it's not to the scale of 200 billion. Maybe that one bright spot is, people are not going to move to data centers in space as quickly as, SpaceX and XAI are laying out. And if that is the case, then some of that enterprise demand will certainly come to Amazon because they're the largest public cloud provider.
And along with the hyperscalers that have gotten hammered this week, the epicenter of the damage still continues to be software. The index in the S&P is up 1.7% this morning, but it's fallen for 7 days. It's in a bear market. As we assess the landscape and what's been selling off in the latest announcement from Anthropic, be it legal work or financial work, to what degree was the reaction overdone, and to what degree was it justified for just how badly software might be hurt?
Well, right now, there is a lot of uncertainty in terms of what are the capabilities of these models in terms of disrupting existing software packages. And that's why the market is reacting the way it did, where it just sells everything indiscriminately. We just put out a note today saying cybersecurity is one of the sectors that is almost impossible to disrupt using these LLMs, because you need a lot of system log data that you're not going to find on the open internet. So from that perspective, you have to find those pockets within infrastructure that are least likely to be disrupted. And clearly, there has been an overreaction on that front.
How do you expect this to settle out, Mandeep? Because if you're going to disappoint the market by spending too much, but also lose ground in cloud by spending not enough, you're kind of stuck between a rock and a hard place.
Yeah, I mean, that's where I think the margins are very important. So in the case of Google, the incremental margins for their AI workloads are above their overall cloud margins, and it's driving a margin expansion, and it's coming with accelerating top line growth. That's where Amazon has to clearly show its vertical strategy. Are the Trainium chips good enough in terms of getting the same kind of rental prices that NVIDIA GPUs and Google TPUs are getting? And if that is the case, then when will that margin expansion start to show up? Because that's what the street cares about, that they should not be diluting their margins in cloud by over-investing right now in their CapEx.
Mandeep, thank you for all of your work this week in what we already knew was going to be busy, but ended up being even more insane. So we especially appreciate it. Mandeep Singh of Bloomberg Intelligence. Coming up in the next hour, we're going to discuss Anthropic's AI model for financial research and the impact it will have on Wall Street. Stay with us for that. You're watching Bloomberg Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check at what's going on in the stock market to end the week. Some serious dip buying going on at the S&P now at more than 1%, but still at 68.76, so 125 points off of the intraday high. The NASDAQ gaining 1.1% after the big drop that we saw yesterday. You can see that NVIDIA is up today more than 5%, and that alone is enough to power this market to gains. Amazon down 8.8%, almost 9%, and that's going to take off a lot of what NVIDIA's added. The software drop that we've seen this week, hundreds of billions of dollars of market cap erased on concern that AI will disrupt software, is being bought now. iShares Bitcoin Trust also being bought back up after it dropped below 61,000 yesterday. The Spider Gold Trust coming back. That's basically and silver as well. That's basically the theme of the day, is buying everything that's gotten crushed so far this week. Dani, it looks like that's going to be enough to power us up. But the question is, do we get anything that turns us around? Another announcement from Anthropic, anything out of the White House, worries about a shutdown on this day when we normally would have jobs data.
It's true. And those ETFs are going to be important to watch, because the retail crowd has really added to the momentum of not just the metals trade, but the equity trade, the Bitcoin. They all have become very interlinked. So the fact that flows are starting to come back and that they're in the green today maybe is a good thing. By the way, tune into ETF IQ on Mondays at 12 p.m. noon time. Coming up, your second hour, Bloomberg Open Interest.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. It's a market rebound, but we did have 3 days of selling, the worst since November, or at least the fall of last year, the worst for software stocks, and even more for that, they're now in a bear market. It's everything from software to hyperscalers. It was really everything joined in yesterday, Matt, after bad jobs numbers, too.
Yeah, it was a tough day, although, with the drop in Bitcoin, I don't think we saw the cascading effects, at least haven't yet, that Michael Burry was warning about. We have economic data crossing the Bloomberg terminal right now. You've got University of Michigan sentiment numbers coming out, and they don't look so bad. Let's break down the numbers with Michael McKee, Bloomberg's international economics and policy correspondent, who is in Atlanta. Mike?
Yeah, Matt, we have no jobs data today, but we do have these interesting Michigan numbers because it's quite the difference from what we saw with the Conference Board, which showed a lot of confidence dropping across the country. In this case, the Michigan numbers go up 57.3 for the final read in the month of January. The current conditions index goes up to 58.3 from 55.5, and the expectations index is down only fractionally, 56.6 from 57. Now, the number that the Fed will be watching, obviously, is the inflation expectations figures. And on a one-year basis, we see a big drop in inflation expectations to 3.5% from 4%. And from the 5 to 10, it's a tick higher, 3.4 from 3.3. But that one-year number is going to give the Fed a lot better feeling, perhaps, about what is happening with inflation at a time when the numbers we've seen so far on jobs this week have not been good. Now, remember, next week we get both the jobs report, delayed from today, and the CPI report. So both sides of the mandate are up next week.
Hey, Mike, as Matt mentioned, you're in Atlanta, and we were lucky enough to watch your excellent interview with outgoing Fed Governor Raphael Bostic. You talked about a lot, inflation, some existential questions. What was your takeaway?
Well, obviously, he thinks that there's still a lot to be done, and it's a very difficult time for the Fed. He won't be voting anymore, but inflation is still high, and there is still some weakness in the labor market, and so the Fed has to be very cautious, he said. But I did ask him about the consumer and how they're feeling these days, because we saw the big drop in the Conference Board numbers, and now we've seen the big rise in the Michigan numbers. Here's what he said.
For today, I think most businesses and most households are not thinking that the worst of the possible outcomes are going to happen. They're not sure they can get to the best ones, but everyone's trying to find a steady state where they can get through. So I think the sentiment is one of cautious optimism, but I'd put emphasis on the cautious as opposed to the optimism. I think people are really trying to wait and see what happens.
And he said if people continue to feel okay about the economy and we don't see any major drops in employment, that could lead to a rebound in growth over the course of 2026.
Mike, thank you so much. Again, excellent interview with the Atlanta Fed President Raphael Bostic. That's Bloomberg's Michael McKee in Atlanta. I'm pleased to say joining us now is David Kelly, Chief Global Strategist at JPMorgan Asset Management. David, did you survive the week? You feeling okay?
I did. It's been a little bumpy,
Just a little bit. What do you make of it all? I mean, it's everything from jobs being a driver to hyperscaler spending to concerns about software. What scars do you think will last from this week, and what was overdone?
Well, I think you've got to separate the market from the economy to start with. You know, I mean, maybe confidence is up a little bit, but that number, 57 or whatever it is, that is lower than it's been 95% of the time over the last 50 years. The median the average American may be doing okay, but from a statistical perspective, the median American is not. The data are all being skewed by the fortunes of the top 10%, top 20% of households. They're doing fine, but everybody else is really just struggling here, and I think that's what's still showing up in confidence. So overall, even on jobs, it's not strong, but the labor market is tight, which is and that's a problem. We estimate, based on the Census Bureau data that came out last week, that the working age population is falling by 20,000 people per month. Every month, falling by 20,000 people. So, we've got this tight labor market, but there's not a lot of growth in the economy overall. So that's what you've got on one side, a pretty soggy economy, not about to fall into recession. And then you've just got this blow-off at the top in terms of this these hyperscalers. And I think there's just so much capital spending going on. I think there's some legitimate questions being asked about, is this ever going to generate enough profit to justify itself?
So we're looking at an economy that's humming along, although the have-nots have doubts, and the hyperscalers are maybe spending too much money for something that we don't yet quite understand the full promise of. Yeah. But if you look at earnings, they're still pretty amazing. I mean, double-digit, like 12% returns thus far, and this after double-digit returns last year as well. Does that continue?
I think part of it's very genuine. If you look at the profit share of GDP, it's been going up and up and up. And what's happening is because the average worker feels miserable, you ask them about the economy is terrible, they also feel like they don't have any bargaining power. And so what we're not seeing, even though the labor market is tight, we're not seeing wage growth going up. In fact, it's going down. So all the productivity gains are going to companies. That's true. But the other thing is there's something a little artificial about the artificial intelligence profits. I mean, if company A decides, I'm going to spend $50 billion with company B, then company A says capital spending. They only have to depreciate a sixth of that, say. But company B, it's all revenue, goes straight to the bottom line. So that one transaction pushes up total profits by $40, $50 billion. So if you see this massive expansion in capital spending by technology companies, it will automatically push up profitability. Mathematically, it has to. And I don't think that's quite the same thing as ongoing profitability.
I'm going to think out loud for a second, so just hang with me here. I wonder if the past week, then, we should be more worried about it than just 1 week of selling. Because if it continues, not only do you get the hyperscalers punished for spending more, you get the private capital stocks punished for funding them. Does that create an environment where maybe the willingness to spend or to lend to the capital, to the big capital spenders, starts to creep back? And because it's becoming so important for the earnings picture, for the economy, it has a really dangerous kind of snowballing effect.
Well, there's risk there. And I think the other part of the story that's been going on all year, and you can see this also in international stocks and the dollar, is people came out of last year 3 super years in equity markets where people are over-concentrated and they're rebalancing. And the questions about, well, maybe I don't need any software companies because my faithful assistant Claude can do it all for me. That may be part of the story here, but I think there's a bigger narrative is people are just prudently rebalancing, and it's not that this is bound to happen. The thing about a bear market is you know not the hour nor the day, but you do know the location. The epicenter of a bear market is always a place where there's been the most hype and euphoria and easy money going forward. So it's not surprising to see Bitcoin take it on the chin or the hyperscalers take a hit this week, because that's where all the enthusiasm has been.
If we do see a real rotation here, and we have to see that in order for stocks to climb, right? I think your strategist has the S&P at 7,500 finishing 2026. Is it possible to get there without, Mag 7 leadership?
Yes, but usually when markets rebalance, they rebalance on the way down rather than the way up. I think that's what happens. You have the things that are obviously overpriced come down, and then the market begins to move up again. Now, the flip side of this, different part of our company puts out year-end numbers. I'm not going to give you a year-end number. But I think we also need to recognize that over the years, there's been a structural change in equity markets in particular, which is just plowing money in year after year. The growth in defined contribution pension plans is pouring money into the equity market much more than defined benefits did. The fact that we had $1 trillion in stock buybacks last year, that was compared to $600 billion of dividends. The one thing you know about that $1 trillion is it's all going into buying stocks. Right. And so you've got so much money going in, and then you've got these embedded capital gains, which makes it so hard to get out, that it's just pouring money in. So once the market finds a floor, it's very easy for it to rebound.
And by the way, it's going in everywhere, David. Yesterday we spoke with Mike Arrighetti of Ares, and despite all the hand-wringing over private capital, they had the strongest inflows in their history.
And then in public bond market, spreads are incredibly tight, too.
Well, yes,
so
in a way, it's part of what we were talking about at the start, which is that the top 10, 20% of households are doing very well. The rest of households are lagging behind. But what's the biggest consumer spending difference between the rich and everybody else? It's not spending, it's saving. The top 10% of households save 35% of their income. The rest net save zero. And so when all that money flows up to the top, it then flows out into capital markets across the board. And all of this is, this is why I think it's so easy for the market to rebound from lows, even though we've got, genuine fundamental worries.
I think that's a theory I've also heard from one of our in-house quants, Stephen Hu, who basically says that the K-shaped economy saves the stock market in another way because a really rich person can only buy so many yachts. Yes. And when they have more money to put to work, they're just going to keep plowing it back into the market.
Well, that's what they do. And we've seen that over the years. I mean, we've had 40 years in which the stock market has given us a total return on average of 12% per year. That is astonishing. And it's been going on for so long that we don't even recognize that it's astonishing, but it has built a humongous amount of wealth. But the longer it goes on, the more you have stock buybacks, the more you have embedded capital gains, the more money just gets sucked into the market and has a hard time leaving.
David, what do you expect from Kevin Warsh? I mean, assuming this DOJ issue goes away and, Tom Tillis steps out of the way and allows him to be confirmed, what kind of Fed do we look for under Warsh? Well,
I think it will be a little bit different. I mean, the job is Fed chairman, not Fed chief. And, under giants like, literal giants like Paul Volcker or intellectual giants like Alan Greenspan, Ben Bernanke, and Janet Yellen, we had, this extra premium in terms of leadership. These people were so respected by their colleagues as being so smart that they were able to bring the majority with them. I think the new Fed chair, assuming Kevin Warsh is approved, he's going to have to work with the committee because the committee is skeptical, and I think they are very determined to maintain Fed independence. So what I think will happen is, I'm not sure that he isn't too. I think it may be a very different Kevin Warsh in terms of being in the job relative to the person who's getting nominated here. But ultimately, I don't think the Fed's going to change direction that much because I think this is one institution where there's a lot of stability in terms of independence, and they're focused on their dual mandate, and I think they're going to stay that way.
David, this has been so thoughtful. Thank you so much for joining us this
Anytime.
morning. Always appreciate your time. David Kelly of JPMorgan. We're over 30 minutes, about 40 minutes into your cash equity trading day. It is a rebound. How long will it last? We're up more than 1% on the S&P 500. The NASDAQ somewhat lags. The Russell 2000, though, the outperformance up more than 2%. That thing has taken off. Basically, every industry is higher except for communication services and consumer discretionary, partially because of what's happening with Amazon, so those shares still continue to fall.
All right, coming up, Julia Coronado of MacroPolicy Perspectives. She expects the Fed to stay in a holding pattern. She joins the show next. This is Bloomberg Open Interest.
We've been in a situation where inflation has been too high for too long. And by many readings, it's been kind of marking time. It's been at a plateau well above our target for the better part of 2 years. That's not acceptable. And for me, I think we can't lose sight of the inflationary concerns. The labor market is very turbulent right now, and some of it is because there are some big structural things that are happening in the economy.
That was Atlanta Fed President Raphael Bostic speaking here on Bloomberg Open Interest. Joining us now is Julia Coronado, former Fed economist who now runs MacroPolicy Perspectives out of Austin, Texas. Julia, great to have you on the program. What's your take on the labor market right now after a string of disappointing data points? We just heard David Kelly of JPMorgan say, despite all of that, it's still pretty tight.
Yeah, so that reflects the fact that we've had a huge hit to labor supply from the immigration policies. So that, given an aging workforce and very limited immigration, we've got a workforce that's basically not growing very much, if at all. Nonetheless, we do still see signs of weakness. And I think what we're starting to see actually is a bit more churn. I think the labor hoarding story has come to an end. Companies are feeling freer to do layoffs, to let go of workers as if they need to rescale their operations. But we're also seeing, say, the Indeed measure of job postings stabilize. We're seeing signs of stability in the temporary staffing industry. So I think we're moving from a labor market that was in low hire, low fire to one that's going to experience a bit more churn, even at a lower run rate. I think structurally, the break-even rate on payrolls is probably 0 to 25K per month. So that's very low numbers. But within that, I think you're going to see a bit more firing and a bit more hiring going on in 2026.
Julie, does that create a more healthy economy to have that churn, or does it impact spending because of the uncertainty? What's the overall consequence of that change?
Yeah, I mean, consumers are cautious and, we've got a little bounce in sentiment, but sentiment's pretty depressed and wage growth has continued to trend lower. So virtually every measure of wage growth slowed last year. And as President Bostic pointed out, inflation did not. So consumers are barely breaking even on gains in purchasing power. So that's, a tough environment for the average consumer. Your prior guest was talking about the K-shape. That's very much still in place. So I do think a little bit more churn is healthier for consumers that want to find a better fit, for employers that need to right-size their operations. Dynamism, generally, economists think of as a good thing. But that's not to say that we're moving into some kind of bullish labor market. It's a tough slog for the average worker.
By the way, is that, Julia, why seemingly nobody expects inflation to reaccelerate? I mean, past really 3%. We heard news from Stellantis today that they found higher prices mean no one buys their products. So the only choice is to lower the prices. I'm not suggesting that prices fall, but it seems like purchasing power is holding back any further price increases.
Absolutely. So one thing that's a conundrum for the macroeconomy is that the overall aggregate consumer spending is largely driven, or often can be driven, by the very top, but inflation is set at the median, right? It's the average household and what they're willing to bear that really sets the prices that we see in the economy. So we've got this very, resistant consumer to price increases because they are very budget constrained. That might change a little bit with some fiscal support. I know a lot of retailers and car makers are looking to the tax refund season to maybe push through some of the higher costs that they're experiencing. So we'll see if we get a little bit of lift in goods prices when those tax refunds come through. But in general, I think inflation dynamics look more stuck at a higher run rate than the Fed is comfortable with than actually something that might turn higher or surge in the near future. And absolutely, a constrained consumer is the story there.
How depressing is that retailers are waiting for us to get our tax returns and rubbing their hands because now they can pass through tariff costs.
Yeah.
They're like, as soon as they get back 15% more in tax refunds, we're going to charge them 15% more for the products.
But it's also part of the flywheel of what happens when you get stimulus and the inflation that might come with that. Julia, I had heard this one argument, though, that perhaps we're overemphasizing, or when we think about inflation and CPI, the way CPI is constructed is that it overemphasizes goods inflation. Because if you have a lot of money, if you're at the top of the K-shaped economy, you're only going to buy one carton of milk. Because you're doing well and stocks are going up, you're not all of a sudden going to be buying more milk. There's only so much that you can drink. But you are going to be doing things like more expensive items. You're going to be putting more of your money into the stock market. You're going to be investing more. I just wonder if there's a whole other part of inflation that maybe the headline number doesn't totally capture.
I think you might be hinting at the idea that we should be looking at asset price inflation, not just consumer price inflation. Of course, the Fed prefers the PCE price index because it does better capture the consumer basket in aggregate. So I think that consumer price indexes are what they are. They're carefully constructed to represent what the aggregate consumer is buying. But yes, wealthier households save more. That can push up asset prices. And as you guys were alluding to earlier in the discussion, that you can get sort of a self-reinforcing dynamic where higher wealth gains lead higher income consumers to plow more cash into the stock market. That certainly is what we've seen over, let's say, the last 3 business cycles since the late 90s, is that business cycles, and they didn't used to be, but now they come with asset price cycles. You get booms and busts. And that's much more a feature of our macro economy than it was, in a bygone era. So I think we do need to think about that. I think the way that the Fed tends to think about that is more through the lens of financial stability. So the Fed, for example, is well aware right now that the economy is being supported by a narrowing base of AI investment, AI-driven wealth creation that's getting cycled into consumer spending amongst high-income consumers. That's not as robust a base as you would like to see. And so the economy is vulnerable to a pullback in asset valuations should that come about. We've seen a bit of a wobble, but really nothing much in the grand scheme of things, given the run-up in asset valuations.
True.
But if we saw something more significant and sustained, that could be something that in turn would lead that higher income consumer to pull back, and then you've lost that narrow base of support.
That's
so
the
I think
cascade.
that there is a reason to look at asset price inflation.
Julia, thanks so much for joining us. Really appreciate your time. Julia Coronado there of MacroPolicy Perspectives. This is Bloomberg. Just about an hour into this Friday session, investors are buying the dip.
That they are. Will it last? Have we put a floor in? We're up 1.1% for the S&P. The NASDAQ just underperforming, up 1%. Even Bitcoin is coming back, but it's under 70,000. A painful day, and just how correlated are all these things with Bitcoin, gold, all the things falling?
It's true. It's come a long way down, but if you'd told me 10 years ago Bitcoin would ever trade for $68,000, I would not have believed you. Coming up, we'll speak with Dirk Wallinger, the CEO of York Space Systems, as interest in the defense sector intensifies. This is Bloomberg.
Liftoff Mobile has been grounded. The Blackstone-backed AI marketing platform has delayed its IPO. They've cited the recent rout in tech stocks and market conditions. Bloomberg's Anthony Hughes joins us now for more. And this is the thing for everybody saying it's IPOs are coming back. This underscores that market volatility is still with us. So to what degree, as John Gray said, is it really the year of the IPO in 2026?
Yes, well, I think we've come into 26 with some very bullish forecasts for the IPO market. There's a lot of expectations. This is going to be a huge year for IPOs, especially with these mega IPOs we've been talking ad nauseum about. But there's lots of other different types of IPOs. And one other area which people were expecting to be quite busy was the private equity-backed IPO. Now,
which Liftoff is?
Liftoff is private equity backed by Blackstone and General Atlantic. But it's more of a growthy type company. I mean, a lot of private equity companies, as you know, tend to be more mature companies. Like we saw in December, Medline, which was a very old company that was a very successful IPO for the sponsors there, being Blackstone and others. And I think they were hoping to leverage off that success and have a good win here. But they absolutely ran into a buzzsaw in terms of the market here. And in this case, they were closely compared to several other mobile app monetization platforms, and that names like AppLovin and Unity Software, which are names they're pretty familiar with. I think people who are active traders in the market, and they've come off brutally in the last few weeks, but in the last year, and those two stocks, and also Trade Desk is another one. They're down 40% this year, which is a massive move, and it just changes the whole valuation metrics, and it makes it really difficult to price an IPO like this.
He mentioned one of the owners was GA. I happen to have the General Atlantic CEO Bill Ford on. If you haven't heard, I have a new show every Wednesday called Bloomberg Deals.
Have you seen?
Did you
see Anthony her debut show on Wednesday?
Yes, brilliant.
A 1 hour deals show that we're all very excited about, and we're looking forward to. Bill Ford.
Correct.
No relation.
No relation to the Ford family.
To Bill
correct.
Ford.
But General Atlantic CEO, yes.
But you know what? I'm glad you brought up Trade Desk. I talk to Mark Douglas from Mountain all the time. They IPO'd last year, and their stock has lost 50% of its value. And this is a similar business to what Liftoff does, right? It takes advertising and tries to place it in the correct spots so that the target consumer sees. I wonder if there's really a worry about IPOs or for a specific subset of companies, right? Because we obviously have seen the SaaS-pocalypse, and although this isn't necessarily software as a service, it falls into a similar bucket.
Yes, I think for sure AI disruption is an issue for software, obviously, but also for companies like this, which is a software company too, but it's really an ad tech company. So that area is obviously going through a lot of changes, is potentially going through a lot of changes as well. And just a lot of uncertainty around what a lot of these companies are going to be doing in a year or two, which is somewhat the nature of tech, but obviously magnified by all the things that are happening in AI. But yes, we haven't. But to be honest, we haven't seen a lot of software IPOs for probably 3 years here now. So that used to be a very large component of the IPO market. It's fair assumption now it's going to be a very limited portion of source of IPOs for the near term, and it's problematic because a lot of the companies that are in certainly some private equity portfolios too, and we've talked about private credit and what's going on there, but there's a lot of private software companies that would like to go public, and it's going to be very difficult.
Well, the big software IPOs we're expecting are OpenAI, Anthropic.
Yes,
they might be okay.
We might put them in a different category as AI companies, but that's a good point.
That's my point, is that they do all the same stuff as all these software companies that have lost value, or they can do that stuff. That's the worry, right?
Yeah. I mean, the death of software at the hands of AI is obviously a massive theme in the market, as we've talked about a lot. But yes, so tech companies that want to go public are going to have an AI story, obviously, and that's going to be very important for any tech company that wants to go public near term.
Anthony, thanks so much for joining us on set. Bloomberg's Anthony Hughes talking to us about Liftoff Mobile. Turning now to a company that actually came out with an IPO. Defense firm York Space Systems officially went public last week with an upsized IPO, raising $629 million. We saw the CEO, Dirk Wallinger, ringing the opening bell, and he joins us now. Dirk, tell us, first of all, I mean, congratulations on the IPO, and we'll get to the money you raised and what you're going to do with it and, your mission. But tell us, first of all, about the IPO process, the decision to go public, and how smoothly it went. Well, you might want to unmute yourself. Are you muted?
Yeah, of course I had to do that one, right? So, yeah, the process itself, right, is it's a lot of work. It's weeks and weeks of work at the end just before, but 6 months worth of effort just to prepare for it, and in my case, a decade and a half as a founder, right? So it's a lot of work. It was the right moment for us, though, for sure. In the space sector, we've seen a lot of excitement since I started this company back in 2012, but it started out with there was a lot of VC investment. There was a lot of excitement around asteroid mining, things like that. That kind of went and died off. And then there was a kind of a SPAC boom there as well. And York really didn't feel like we were prepared to be in the position that we should be in order to take advantage of the markets at that time. But right now is the right moment for us. And so with the hard work, the strong backlog, the proven products and execution, we thought, we are a public company. We're ready to go public. And so we started that process about 7 months ago.
I'm just curious because, there are some companies in the market right now that have been working on the same process that you went through, but have decided not to, as we're just talking about with our reporter, because it is a nervy, it is a jumpy, and it is a volatile market. Did you have any second thoughts just because of some of the selling we've seen, or was that not a factor at all for your timing?
Yeah, I mean, for us, it's just a matter of maturity where we thought we were as a company. I mean, the reality is access to the markets is a very great thing for us. It could be very helpful. But you have to have proven products. You have to have a great backlog. You have to have the ability to execute where you're not constantly watching your stock price and kind of having that being your decision metrics on what you're doing. This capital raise for us was not about covering operational expenses or trying to develop a brand new product, right? This for us this is our ability to expand, go on the offense with our ability to produce for this country, for commercial markets and national defense. And so we were just in a different position where, I don't need to worry too much about the stock. We're going to create value for our investors over the long term. We know that we can do it. We're in a perfect position to do it. And so that's why there really wasn't as much hesitation for us.
What's your expectation of the market you're looking to address? How much growth do you see, and where is the revenue going to be coming from?
Yeah, I mean, historically, the growth has come obviously from national defense and the United States government, but we're starting to see that change. So there's some really exciting commercial customers, some of which we're working with, providing services that kind of used to be government-based, but they're switching to the commercial market now. And so we're working with commercial companies to deliver that capability too. The reality is, right, is in the long term, no one will make an argument that satellites are not going to become an increasingly more important part of this economy and what the United States needs. No one's going to make an argument that in turbulent kind of political or world global times that national defense isn't important. So, over the next, 5-10 years, there's tremendous growth in this industry, in this sector, and for all the things that we're doing. And that's really where our focus is let's focus on the 5-year, let's plan for that, and let's execute, because there's no question about growth here.
And Dirk, of course, you have a long history in the defense sector, having worked at Lockheed Martin and General Dynamics. One aspect of the defense industry when it comes to space is this desire for the Golden Dome project. And York is obviously very well positioned as a top contender to work on any of those future national security systems. How should we be thinking about that in particular? Because it feels a little bit sci-fi. It feels very much so it's still a concept. What is the real-world potential of something like a Golden Dome?
Right, and do we need to take over Greenland in order to put it in place?
So on Greenland, we'll probably follow back to that one. But yeah, as far as the technology, the reality is it is very exciting. It does sound very sci-fi. We've heard similar things, I think, the Reagan era. But the reality is it's not that far off. Most of the challenges here with Golden Dome is actually getting disparate systems to talk to one another. We actually do most of these things now, just not at the scale that's being asked for. So that'll be the real challenge is, connecting things like ground-based missile defense in Alaska with, submarines have capabilities as well, right? And those are two completely different systems. And Golden Dome is about, we need them to talk to one another. That's what's going to be important. And so Golden Dome will be about piecing these disparate systems together, getting them integrated, making them more autonomous because we don't have time to react on the timescales that we've done in the past, and then just scaling them up, in large quantities, orders of magnitude or two beyond what we've done here. And it makes sense, right, that space should be the backbone of that. Space is kind of the above all, see all aspect of this. It has the ability to connect these systems. York itself has done many exercises with the military where we are connecting these systems. We're talking to Navy assets, Army assets, Space Force assets. And so it'll just be a scaling up of that. And so I think that's probably why people haven't heard as much about it, is because we're gonna scale up existing capacity that we already have. I mean, L3 had a $1 billion convertible that they're working to scale up solid rocket motors. Why? Because those directly have impacts on Golden Dome capabilities as well. So we're just going to see a lot more of that. We'll see a few more capabilities, I think. Yep.
Well, Dirk, I just want to jump in because we're running out of time and I really want to get this in because it's another thing that is talked about from guests on the show. It's talked about Elon Musk with SpaceX that also feels very sci-fi to me. And I would love to get your thoughts on data centers in space. It's something that a lot of people have posed just given the demand for AI empowering. Well, do you think that's also the future we're headed towards? How realistic is that?
It could be a possibility. I think there's a lot of, frankly, physics that need to be worked out with that. The reality is convection is 10 to 20 times more effective than radiation. So there's a lot of pointing to, radiation is very cold, but it's a far less thermal heat transfer mechanism. So that's going to be a challenge that needs to be overcome. Another one would be that, what are the most expensive things on our satellites? Dollars per kilogram. It's the solar cells. So those would need to change in magnitude as well, because you're talking about solar arrays that are size of, tennis courts or football fields. And so if that's the largest piece of what you're doing, and it's the most expensive piece, that will need to be solved too. So there's some things to work out, I think, before that becomes a reality. All that said, are we working on those capabilities? Do we have platforms today that can do that? I mean, absolutely. If we can get the cost to pencil out, we absolutely have that capability. And, Elon is someone who has figured out very challenging problems in the past. So, we're never going to underestimate that. We're always going to keep an eye on kind of the capabilities are there and if they're possible. So.
Dirk, this has been a really interesting conversation. Thank you so much for joining us, Dirk Wallinger, the York Space Systems CEO off the back of their IPO. Speaking of IPOs and other deals, my new show, it premiered just this past Wednesday, Bloomberg Deals. It will air every Wednesday, 12 p.m. New York time. We track the power players' major moves and capital flows shaping global markets.
Very cool to see that show launch, and I'm looking forward to the next program. Let's get a check on what's going on in the market today. Looking at a bit of a rebound here with the S&P 500 up 1.25%, 68.83 the level there. Bitcoin as well coming back almost 10% right now, 68,578. The Gateway Commission has suspended construction of the New York-New Jersey tunnel. The Trump administration froze funding for it last year, and the commission sued the administration earlier this month. The project is intended to ease congestion between New Jersey and Manhattan The tunnel under the Hudson River is one of the most ambitious infrastructure projects in the country, but it looks like at least 1,000 people are out of a job starting this morning as construction stopped.
It also threatens 95,000 other jobs that are linked to the project and $20 billion in economic activity. That's at least what Gateway has
I thought the
estimated.
idea was as long as we just rename Penn Station after President Trump, then he'll allow the money to flow. Did you not hear?
I missed that. Was that part of the conversation?
That was what I was hearing from Michael Barr this morning on Bloomberg Radio.
Okay. Well, I guess we didn't do that, and we're not getting the funding for it. So there you have it. Sorry for everyone's commute.
Stay in New Jersey.
Okay, coming up, Wall Street bonuses are getting a bump thanks to a strong year of returns. So congrats, you can afford a car and wait in traffic. We're going to get the details next. This is Bloomberg Open Interest. After a banner year in deal-making, JPMorgan, Goldman Sachs, and Bank of America announced that they're boosting their bonus pools by at least 10%. They reflect a strong year for big banks, which posted their biggest annual profit since 2021. Bloomberg finance reporter Catherine Doherty joins us now for more. Is this the return of M&A encapsulated now that everyone's getting big bonuses?
I do think it's a reflection of the strong year. 2025, M&A is returning. Not only is it returning, but there's signs that it's going to continue into the year ahead. So that's an important kind of factor when banks are thinking about both how to reward their people, but also how to keep expenses in check. It's a fine line that they're walking. And when they're talking to their investors, at the end of the day, they want to keep their best talent, but they also can't overpay and then worry about down the line if expenses are running in a unsustainable manner. So I think that this 10% average that we're reporting today, now you have rainmakers that are going to be making almost double that. Some people are actually going to be seeing donuts if they're underperformers. So this is, just to keep in mind, an average. But it does signal the strong year of how both investment bankers and traders ended last year.
So, but until we put out the Jeffrey Epstein offers Ambani a tall Swedish blonde story, this was the top of the list in terms of most read, right? Everyone wants to see who's getting paid and who's not. So how does that break down? I mean, which, aside from rainmakers, are the people who are going to be seeing the bonuses and who isn't going to?
So it really depends on this, again, average across, we reported today, Goldman, Bank of America, but it really depends on the bank. If you dig into not just the bank, but then within the units. So investment banking, if you're thinking about year over year, 2025 was a much better year than the previous time that we're thinking about when deals we hadn't seen the resurgence. So that year over year increase is going to be steeper for investment bankers. But I will say traders, they've been seeing a pretty good runway. 2024 was a great year for them. 2025, even better. So if this volatility continues and they're handling more orders on behalf of their clients, you can expect that the payouts are going to be pretty sweet for those trading desks.
And maybe there's going to be less employees, so there's even more money to go around. With that Anthropic story that they've released a new model around financial firms and the ability to do work there. Do you understand just how advanced that is and if banks are already implementing any of it?
I do think that each bank has their own path forward that they're taking, and they had to do this over a year ago. They really had to create workforces that were focused on how to implement AI strategies within their units, whether that's trading, investment banking. You see that now start to actually come through in some of the earnings. But I do think that as far as what the executives have talked about on earnings calls, that is early days. And so when you think about other partnerships, you mentioned Anthropic, these are things that the banks are going to have to decide. Do you build in-house? Right. Do you start to partner? But you're hitting on a very important topic, which is efficiency. Again, keeping expenses down. So if you're talking about paying your best people, you can pay your people more if you're saving in other parts of the business. So this is going to be kind of the biggest hurdle that banks have to deal with moving forward is how do we spend so that at the end of the day, we can pay our people more, but maybe we need less people to do more work.
Right. Catherine Doherty there covers the banks for us at Bloomberg News. Coming up, a $49 a month pill is rattling a $60 billion drug giant. This is Bloomberg Open Interest.
Novo Nordisk says a copycat weight loss pill launched by Hims & Hers is illegal and unsafe. Novo is vowing legal action. Let's get the latest. Sam Fazeli, senior pharmaceuticals analyst from Bloomberg Intelligence, joins us now. Sam, it's this battle that's been unfolding over the past couple of days, but compounding pharmacies have always existed, well, not always, have very recently existed and been putting these things out. This pill do we know if Novo's correct that it's illegal and it's unsafe?
Well, it's definitely illegal. I mean, let's face it, when the year or two ago, the compounding pharmacies were allowed to sell these drugs, first, all they were doing was buying the active ingredient and providing it in a vial, and folks had to then inject it themselves. And also that fell under there isn't enough supply, therefore that's allowed. That then ended. That should have ended then. And the pill is a very different game here. The large amounts of drug go into a pill. It's a highly technical product. And to be frank, it's covered with a patent. Well, you can't just, if willy-nilly, go on out there and allow the companies to sell patented drugs. Otherwise, where do you stop? And what's the incentive for pharma companies to innovate and develop these things? So Novo is absolutely right to sue here. And in fact, the FDA has finally stepped in and said, this is not right.
It's the dangerous part that worries me more, Sam, because obviously a consumer who looks at the prices that Novo Nordisk is charging is likely to look for a cheaper alternative. If it's dangerous, that's a real problem for the safety of Americans. So is that likely?
Well, I don't know. Do you know if it's dangerous or not? It's never been through a trial. This company has never manufactured this before. We don't know where the supply is coming from. I'm sure they're trying to source it from the best possible place, but we just don't know. When Novo Nordisk goes through years of clinical development and testing it in subjects, they have that data. That's what the FDA reviews and approves. Here, there's nothing reviewed, nothing approved. So I don't think this is right, and I think the market has understood that. And of course, at the end of the day, the company has absolutely the right to fight this back, but it's more important that the FDA gets its teeth back and bares his teeth and says, look, this is illegal.
All right, so it's a problem in the face of maybe a toothless FDA. Sam Fazeli there of Bloomberg Intelligence talking to us about Novo Nordisk versus Hims and Hers. To be clear, Novo Nordisk is actually a $200 billion company, but it had been a $700 billion company. So you can see that it's been hit pretty hard since it came out originally with Ozempic and then Wegovy. In terms of the markets today, we're seeing a resurgence after a big dip yesterday. S&P 500 back up more than 1% at 68.74, and Bitcoin coming back about 8%, 8.5% at 68,511.
So maybe a rebound, maybe a floor. We will see. Coming up on Monday, we got a great show for you after the weekend. Keith Lerner of Truist, Kelly Kovley of Manning & Napler, and Edgewell CEO Rod Little. Enjoy the rest of your Friday and your weekend. This has been Bloomberg Open Interest.